Ever wish you had a reliable weather report for the economy? Something that could actually warn you of a potential storm brewing on the horizon? Well, leave it or not, Wall Street has one, and it's called the yield curve. So let's dive right in and decode what is honestly one of the most powerful forecasting tools in all of finance. Here's what we're going to cover in this explainer. We'll start with the basics. What even is a yield curve? Then we'll get into its famous warning signal. After that, we'll talk about a playbook for your portfolio, reveal a really critical twist in the story, and finally, we'll check the economic weather as of right now, January 2026. All right, first things first. Before we can even begin to read this forecast, we have to understand the tool itself. So what in the world is the yield curve? At its core, it's really just a graph. That's it. It plots the interest rates, or the yields, on U.S. government debt across a bunch of different loan durations. We're talking from a few months all the way out to 30 years. It basically shows you how much interest you'd earn for lending money to the government for different lengths of time. Simple as that. Okay, this slide just nails the two different personalities of the curve. Over on the left, you've got the normal happy-go-lucky curve. It's sloping upwards. This makes perfect sense, right? You get paid more interest for locking up your money for a longer time. That signals a healthy, growing economy. But then, right, that's the storm warning. The graph is literally pointing down. It means short-term rates are somehow higher than long-term rates. This is the bond market's way of screaming that trouble might be just around the corner. So how does this completely upside-down situation even happen? Well, think of it like a big tug-of-war. On one side, you have the Federal Reserve, and they're jacking up short-term interest rates right now to try and cool down the economy. But on the other side, you have investors. They're looking way out into the future, they see a slowdown coming, and they all rush to buy long-term bonds for safety. All that buying pushes long-term yields down, and bam, the curve flips upside down. Now, let's dig a little deeper into that warning signal, because it turns out not all inversions are created equal. You gotta know how to tell the difference between an early alarm and the final siren. Traders, they absolutely love watching the difference between the 2-year and the 10-year yields. It's like the early warning system. It reacts super fast to what the market thinks the Fed is gonna do next. But the Federal Reserve itself and a lot of serious economists, they put way more stock in the 3-month versus the 10-year spread. See, this one is less about speculation and more about the reality of what's happening with policy today. And historically, it's been the most reliable recession predictor we have. Period. Now, this is probably the most important point to understand. An inversion is a forecast, not a fact. When that curve first flips, it doesn't mean the economy implodes the next day. Actually, a lot of the time, the market just keeps on climbing for a while. There's usually a lag, anywhere from 6 to 18 months, before a recession really kicks in. So think of it as a hurricane watch, not the hurricane itself hitting the shore. Okay, so the storm clouds are on the horizon. What does this forecast actually mean for your money? Let's get practical and talk about the historical playbook for how to navigate this kind of environment. When a curve inverts, the whole vibe of the stock market changes. Those exciting, high-growth stocks that do great in a boom, they tend to fall out of favor. Instead, investors start shifting towards safety. We're talking about defensive sectors like utilities and healthcare, and big, stable companies with proven track records and strong profits. The party isn't necessarily over, but the DJ is definitely changing the music. And what about gold? This is where things get really interesting. See, gold's best moments usually come after the inversion has already happened, right when the market starts smelling that the Fed is going to have to switch gears and start cutting rates to save the economy. That's when investors pile in, looking for it as a hedge, a kind of monetary protection for whatever's coming next. The real estate market definitely feels the chill too. An inversion basically screams tight credit and higher borrowing costs, which naturally puts the brakes on price growth. But it's not all doom and gloom. Once the cycle turns and the Fed finally starts cutting rates again, real estate can come roaring back as it gets cheaper to borrow money. This table really sums up the whole strategic shift perfectly. The big takeaway here isn't about perfectly timing the market. Good luck with that. It's about changing your entire posture from playing offense to playing defense. As you can see, the game plan becomes all about reducing risk, boosting the quality of what you own, adding some hedges, and focusing on reliable income instead of risky growth bets. But now we get to the most important, and honestly, the most counterintuitive part of this whole economic forecast. It's a twist that, no joke, changes everything you thought you knew. So you're probably thinking, okay, I get it. Inverted curve is the warning. So when it goes back to a normal upward slope, the danger must be over, right? All clear. Nope, not even close. In fact, this is when the highest risk has just begun. So why? Why is that? Because the curve doesn't just magically fix itself. It goes back to normal because the Fed is being forced to slash short-term interest rates. And why are they slashing rates? Because the economic weakness the curve predicted a year ago is finally here. That re-steepening isn't an all-clear signal. It's the siren wailing telling you the storm has just made landfall.
And that brings us to today. So let's take everything we've just learned and actually apply it to the economic weather report for January of 2026.
As of right now, that key 3-month versus 10-year spread is positive, the curve is no longer inverted, it is normalized, and based on what we just talked about, this means we are smack in the middle of that critical transition phase. The early warning is officially over. So what's Wall Street saying about all this? Well, the interpretations are all over the place. Some analysts think this is just the market doing its job, pricing in those Fed rate cuts that are expected because of the slowing economy. Others are pretty worried about policy uncertainty and the fact that long-term yields are also creeping up. The fear of a recession hasn't gone away, it's just gotten a lot more complicated. And that very concern is being echoed by some of the biggest players in the game, like BlackRock's CEO Larry Fink. He's warning that if those long-term yields keep climbing, it could create a whole new set of problems for the stock market, no matter what the Fed does with short-term rates. It's a pretty stark reminder that there are a lot of moving parts here. Which, of course, leaves us with the million-dollar question that everyone on Wall Street is debating right now. Does this normalized curve mean we're heading for a soft landing, where the economy cools down without crashing? Or are we just in the early stages of that re-steepening danger zone, with a late-cycle recession still on the way? The weather report is in, but the final chapter is still being written.